Hi, I'm Shelley,
And hi, I'm Damien.
and today we're bringing to you a new format of Nucleus Wealth podcast webinar called Nucleus Rapid Insights, where we're going to give you a quick overview of one of the areas we're looking at closely in markets at the moment. So, Damien, what area are we going to look at today?
So today we want to have a look at Chinese housing, and in particular, there's a string of announcements that came out from the Chinese government last weekend, and we really want to have a bit of a look at what that really means from an investment point of view, given the effect the Chinese housing market has on commodities, and how big commodities are as a proportion of the Australian market.
All right, so do you want to start off giving us some context for this? What's brought us this point?
Yeah, so basically the Chinese housing market is pretty much the biggest asset class in the world at the moment, and they use an incredible amount of commodities relative to its size. So the Chinese GDP is sort of less than 20% of the world GDP, sort of more like about 15% of the world GDP, but they use say over 70% of seaborne iron ore, which is basically iron ore that's being exported. They use well over 50% of a whole bunch of different commodities, whether it's alumina, nickel, aluminium. You just go through the whole list. All these commodities are just a mass. China uses a much bigger proportion than you'd expect, given their population and their GDP. And it hasn't always been that way. That's really risen over the last 20 years. And you say crude steel is a good example. Is that they used to go? They went from being 100 million tons of crude steel, whereas the rest of the world was sort of 600 or 700 million tons. Now China is using almost 1 billion tons, and the rest of the world is still sort of using maybe closer to 800 now, but it really hasn't changed. It's really been this massive rise in the amount of commodities consumed by China. And so then the question goes is, well, what are they doing with all these commodities? And most of it goes into the construction sector. So China is building an incredible amount of houses. If you look at the houses and in particular high-rise apartments, and the high-rise apartments do tend to use a lot of steel. And in terms of China, what happens is they've been building so much, and they've got so much of their economy is geared around the construction part, that one, it sort of drives their economy in ways we've never seen. But also, what it means is that if you're looking at commodities, you really do need to start from the first point of what's China's housing construction doing, because that's going to give you an input into what's going to be what the demand cycle is going to be for the entire sector. So on the high-rise side, it's worth noting that they're really the biggest consumer of steel. China's doing a lot of infrastructure spending at the moment. But their actual housing starts really have crashed. Their housing starts are back to below sort of 2015 levels, which was the last time they had a bit of a housing pullback, and but they do have further that they can fall. So if you looked at a similar country to China, what you'd find is that based on the level of urbanization and the number of people that they have, you could still see starts falling about another 40%, and they'd be back to what you'd think is a more normal economy. So a lot of this has been driven by urbanization in China, and the big issue though is that urbanization is starting to fall away. They're past the steepest part of their urbanization curve. So most sort of similar countries to China sort of top out at an urbanization rate, so the number of people living in cities, of about a little bit above 80%. China's already at 65%, having come there. At 1980 they were closer to 15%, and they've really rocketed in terms of the number that have come through. The issue though is that for most of the from sort of 2015 to 2020-ish, they were moving about 25 million people into cities every year. That's now taken a huge drop, partly through the COVID, but partly because you just passed that steep part of the curve, and now it's more likely to be below 20 million people going into cities every year. And so you just need fewer houses. That's sort of the looking forward. The issue, though, as well, is that there's been so much building in the past that there's this overhang of extra supply. Some people estimate, also some quite credible estimates are that about 20% of Chinese apartments are unoccupied at the moment. So about 50 to 60 million apartments. And in context of moving, 15 million people a year into cities, that's like the next 3 or 4 years worth of migration you could get into cities without needing to build anything. Then on top of that, you look at the number of apartments that are in progress right now. So have been started but haven't actually been built, haven't actually been completed yet. And there's actually about in terms of that you're looking about 1 in 6 Chinese households actually has a new apartment being built right now. So you've got just this incredible amount sort of still in the pipeline. Then you look at, to look at it in another different way. You can look at, well, what's the amount of residential investment we've seen in China versus as a proportion of GDP? And Japan had a pretty famous housing crash back in the 70s and 80s. Well, China's already double the level of Japan in terms of the amount that's being spent before Japan had its housing crash. If you look at the US, which had a pretty big housing crash in the just before the financial crisis, well, China's spending about 3 times as much on their residential as what we saw in the US before its housing crash. So, whatever way you cut it, China is just this unique beast in terms of how big this housing market is. So that's sort of the longer term picture. The next sort of thing you need to understand is that China knows that they've got a problem. They started spending most of this money post the financial crisis to try and prop up the economy as the financial crisis hit. Then they tried to pull back. They've actually tried 4 times to pull back on this. And the latest version is called the 3 red lines. So in 2020, they announced these. They have announced caps on property lending. They announced land supply reform, reduced credit creation. It's been really trying to crack down and slow down this property construction sector for the last few years. And the issue is, it looks like they've done too good of a job, in some people's view. So that's meant that what we've seen is about a halving of Chinese construction. And now the question with all these announcements that came out over the weekend is, has China pivoted again? So on 3 prior occasions, they tried to slow the housing market down, and then they gave up because it was too economically painful, and they just let the whole thing, even encouraged the whole thing to boom again. The question now is, are these, were these announcements we saw over the weekend, were they actually a pivot? Has China changed, and have they once again given up on this this idea of reforming this massive beast that is the housing house construction sector in China?
All right, thanks, Damien. So, do you want to talk about a little bit about what they've actually done, what they've actually announced?
Yeah, so there's a whole bunch of different announcements came out. So some of it are things they're doing to relax their COVID zero policy, which is also, I guess, moving in this same direction. But there's sort of 16. They've got a 16-point plan, which sort of ranges through a whole bunch of different factors that they're looking at within the housing market to try and help the housing market. I guess I'd characterize the elements pretty much as either one is directives to banks to try and lend more to developers, and most of that is focused on completing existing projects, because there's this real focus for the Chinese government on trying to make sure that properties that have already been paid for, usually by consumers, actually do end up in the hand of consumers, and we don't have that, that 1 in 6 statistics that I spoke about, is that doesn't turn into a lot of unfinished projects where is going to end up in a lot of individuals very unhappy with the outcome. It's one thing for a property company to go bust and have a bunch of apartments that the property company owns go unfinished. It's a different thing when those properties have already been sold to individuals and there's already a lot of unhappy people out there. So that's the first. A lot of the 16 is to do that, and the other is reducing some debt constraints and rules individuals buying houses. Now, while both of those are going to be helpful, the issue is none of them are actually out there going to turn the housing starts around. Is I guess my main issue is the stock market seems to have assumed though that China is starting down a whatever it takes moment. And so what I mean by that is that they've basically signaled to the market that enough's enough. Now they're going to step in, and this is the first salvo, and they're going to follow it up with more. And if it doesn't work, they're going to keep following it up with more and more and more until the whole housing sector gets housing construction sector gets booming again. I don't think that's the case, but the markets certainly have reacted that way, and it is clearly a risk. And so what we did, as these announcements coming out, we closed out most of our underweights. So we basically went, look, let's not sort of stand in front of this train. The markets are assuming that the property boom's back on. So let's let that play out, and let's watch the announcements that are coming out, because at the moment the announcements aren't enough. Maybe they will come, and so in that case, that's where we don't want to be underweight these sectors that are going to boom again. The flip side is, if they don't come out with these announcements, we're going back to what we've seen over the last couple of years, which is that slow grind lower of the Chinese housing market. And in that case, the 16 elements is really about making sure that the whole property sector doesn't pull down the rest of the economy with it. It's not about trying to reignite the boom again.
Thanks, Damien. All right, so what does this mean going forward?
Yeah, so going forward, what we really need to watch now is three different areas that we think are the key parts of concern. One is we've got to watch for credit locking up in that property development sector. So 12 months ago, we thought the option was basically if they didn't do anything, then there was a full-blown financial crisis coming. We thought the most likely path was that they'd implement some steps to sort of help better companies, not to let up too much on over-indebted companies. And that was sort of the middle ground we thought was the most likely. And this plan sort of falls in path with that. At a sort of more bullish end, they could overdo the response, opening up the credit taps, going back to what the market used to be like, and just flooding the market with more and more supply. Now, and that would boom in terms of commodities. The markets have sort of interpreted the China's announcement as that bullish part, but really when you dig into what's been done, it really is just about making sure better companies don't drag down the rest of the economy in terms of it. So that's the first part is watching that. The second part is property buyer confidence. Now, China's got some of the most expensive housing in the world relative to their incomes. If buyers lose their faith in that property is no longer considered to be an asset which you can't lose money on, then that could end up in a house price crash, and it's a sentiment issue. It's about, will people give up on this as an asset class? Now, there are a few signs that Chinese property buyers have been spooked. There's not a lot in these measures that have been announced that are actually going to solve this issue. So this is an area which we're very keenly watching to see what are Chinese consumers doing, because the actual buying is way down on prior years. It's about half what we saw over previous years. And if property developers end up with this huge backlog of stuff they can't sell, then you start worrying about can a housing price then morph into a financial crisis and really leave the Chinese government with very little that it can do to stop that. So that's the most sort of downside risk. And then the final thing is the wealth effects. This isn't unique to China. This is it's a Chinese thing. It's an Australian thing. It's a US thing. We've got a lot of countries that have seen quite significant increases in house prices over the last 2 or 3 years post-pandemic. The issue is, and what usually happens when people see their house price go up, is then they go out and spend more money. So the issue is, in this case, is that if we're seeing that in reverse now. Housing prices are starting to fall. That means people spend less money, and it's something we call pro-cyclical. So the whatever problems are from happening in the housing sector, they can be they can be increased because of weakness in the rest of the economy.
All right. So, what are the investment implications of all of this?
Look, this is, as we said before, this is China's fourth attempt in the last dozen years to win itself off the property construction sort of addiction. Each time on the other three occasions, they lost their nerve and reversed and went back to spending on property to sort of prop up the rest of their economy. I think these announcements, they might be signs that China's once again lost its nerve. And as an Australian investor, with 30-odd% of the ASX in resources, we need to respect sort of the upside risk that if they had done such a pivot, that's going to create for commodity prices and the Australian dollar, especially if you sort of couple that with the reopening plans. But we also need to recognise that all the announcements so far, they really haven't done enough to reignite that property boom. There has to be more announcements if you're expecting that to reignite. And if they don't come, investors need to be ready to pivot back and go back underweight commodities. And there's probably, in that scenario, there's probably considerable downside for the Aussie dollar. So we're looking for that point at the moment. And also noting there's one extra risk in there is that we've got the US Fed rapidly raising rates, trying to cut off demand within the US economy. If China comes back into the market in terms of their demand, so if we see a Chinese property boom come on and this increased demand for commodities, then what that's going to mean is that the Fed's going to have to keep raising rates even further to get the inflation back under control. So sort of one extra risk that is well worth taking into account as well.
All right, thanks, Darren. And thanks, listeners, for listening to another one of Nucleus Wealth's episodes. You can find more of our content on YouTube or your favourite podcast channel. And don't forget that we are live every Thursday, Australian Eastern Daylight Saving or Standard Time, depending on the time of the year. And you can tune in then and ask questions directly of Damien and the rest of the team, depending on what we're discussing in that episode. So thanks again from the team, and we look forward to seeing you in the next one.